This is such a busy time in Washington. Of course, the Pope has just left. We have the state visit today of the leader of China, Xi Jinping. We have the United Nations General Assembly beginning in New York. So this is just an incredible time in Washington and this part of the country, and that's just for starters. So it's an incredibly busy time, and having the undersecretary here with us today, we believe, is an indicator of the importance that he and his department place on economic and financial relations with our own hemisphere, as well as the importance of the U.S. Treasury to our hemisphere. As he has just returned from official travel to the region, this is also a particularly opportune time to hear from him. And there are significant questions facing the region, which is in a much different place today than it has been for much of the past decade. Slowing growth, and in some cases recession, brought on by a number of factors, is beginning to bite politically. As economies soften, governments are facing difficult decisions, and politics are becoming less predictable. And this scenario is impacting virtually every nation in Latin America and the Caribbean, with a particularly strong effect on the commodities exporting nations of South America. To the north, even Canada's economy has lost momentum. Under these conditions, we're seeing a flight to quality as investors seek to mitigate risk, not just in our own hemisphere, but also worldwide. Competition for investment dollars is increasing, even as the region faces huge new requirements in basic public goods such as infrastructure, education, the environment. These are difficult issues which require political will and strong institutions to navigate through. And in such a scenario, the U.S. Treasury is an important partner in building regional economic health and well-being. Our speaker today, Dr. Nathan Sheets, is the point person for these issues, the senior official responsible for advising the Secretary on international economic matters. He has spent his career working on the most complicated global financial topics, most recently as the global head of international economics at Citigroup, and prior to that, for almost 20 years at the Federal Reserve Board in a variety of positions. He's also held positions with the IMF, and he's worked closely with the Bank for International Settlements. As you would anticipate for someone with a doctorate in economics from MIT, Undersecretary Sheets has been published several times in peer-reviewed journals, and prior to his confirmation 1 year ago for his current position, he was a regular commentator on television and in other media, and you've probably seen him several times in such a capacity. He'll be speaking today on Latin America and the Caribbean, challenges and opportunities, and we're delighted to have him with us. Ladies and gentlemen, would you please join me in welcoming to the Council of the Americas the Undersecretary of the Treasury, Dr. Nathan Sheets.
Thank you.
Please.
Well, I'd like to thank the Council of the Americas and the Carnegie Endowment for International Peace for hosting me today, and thank Eric for that very kind introduction. The international financial community will travel to Lima, Peru in mid-October for the 2016 annual meetings of the IMF and the World Bank. Secretary Liu plans to also participate in a meeting of the Western Hemisphere's finance ministers to discuss the region's economic prospects. The Lima meetings will bring to the world's attention the major accomplishments that many countries in the region have made towards shared prosperity, as well as the very significant policy challenges that Latin America and the Caribbean now face. The steep declines in many emerging market asset prices over the last week have demonstrated that it's a difficult time to be an emerging market, and that Latin America is bearing its share of the adjustment. As we prepare to visit Lima, I would like to share with you my views on the key economic challenges that our neighbors face and how Treasury looks to be a partner. In recent years, we have seen a maturing of the relationship between the United States and Latin America and the Caribbean. President Obama has approached the region with a sense of partnership. And I can say that Treasury's engagement with the region's leading economic policymakers, officials such as Secretary Luis Videgaray in Mexico, Minister Joaquim Levy in Brazil, and Minister Mauricio Cardenas in Colombia, has underscored the high benchmark for policymaking in emerging markets. the ongoing U.S. economic recovery highlights the value of two-way partnership between the United States and the region. Those countries that are well positioned to benefit from trade and investment opportunities with the U.S. private sector will reap dividends. More broadly, we want to see governments in Latin America and the Caribbean embracing policy reforms that will enable their citizens to compete in the global market. Engagement with the region is a priority. Secretary Liu has traveled to Mexico and Brazil. I myself travel to the region as often as I am able, having over the last year visited Brazil, Chile, Colombia, and Mexico, and I'm looking forward to Lima. Treasury also maintains a sustained presence in the region with technical assistance programs in 14 countries. Our advisors are working to strengthen capabilities in mobilizing domestic revenues, budget planning and execution, debt management and market development, infrastructure finance, promoting financial inclusion, and combating financial crimes. We are there to support governments that are committed to strong reforms, such as in Paraguay. And we will be there over the long haul to support governance reforms in countries that own their reform agenda and that seek our help. The United States has a special stake in the success of our neighbors. It is clear that the era of ever-increasing demand for the region's commodities has reached an end. The adverse demand shock absorbed by Latin America over the last year has been massive, with a corresponding impact on investment. Economic growth rates and potential growth rates have been falling. The current consensus forecast is for Latin America's economy to contract slightly this year and to grow less than 1% next year. But it's worth taking a step back and reflecting on just how far the region has come since the instability of past decades. We've witnessed remarkable improvement in the macroeconomic frameworks in many of the countries in the region. Many policymakers internalized the lessons of past crises and have worked to put in place the policies necessary to foster stability and resilience to shocks. First, especially given the history of Latin America, it is hard to overstate the accomplishment of having achieved low and stable inflation in much of the region. Central banks in many previously crisis-prone countries have earned credibility and are invested in maintaining it. Second, the region has benefited from the broad adoption of flexible exchange rates. Many countries have been able to lean on large exchange rate adjustments to absorb the impact of external shocks and help adjust the drivers of growth, while ample foreign exchange reserves provide reassurance to investors. This flexibility will be particularly critical in the current global environment to help commodity-dependent countries diversify their economies. Third, the region has made significant advances in promoting financial stability, and banks throughout the region are generally better capitalized and have built stronger balance sheets. In the past, the currency depreciations that we have seen over the past year could have threatened financial stability in the region. But to date, we have not seen such risks materialize. Supervisors and financial institutions are now more attuned to avoiding currency mismatches. Financing sources have also become more diversified, with many sovereigns and corporates now able to borrow in their own currency. Fourth, fiscal policy, broadly speaking, has become more disciplined. A number of countries have explicitly adopted fiscal rules appropriate for open emerging markets, while still allowing flexibility to counter shocks. Improved financial management practices have seen countries like Mexico and Jamaica using financial hedges against volatility in oil prices. With support from the United States and other partners, Caribbean and Central American countries are using innovative insurance products to hedge against natural disasters, such as that recently experienced by Dominica. While many countries in the region have significantly improved their macroeconomic management along these lines, there are still several exceptions. Countries that have done the least to strengthen the fundamentals of their economies are those currently facing the highest inflation rates and the tightest financing constraints. Unfortunately, even for the best managed economies in the region, growth has consistently fallen short of aspirations. During most of the past 20 years, including the boom period of the last decade, growth in Latin America has lagged other major developing regions. Since 1995, for example, average growth in Latin America has been less than half that in developing Asia. This result, in many cases, has come despite the significant effort of policymakers, as earlier reforms, while cushioning against shocks, have not fueled the acceleration and broadening of growth to the extent desired. Periods of booming global commodity demand may mask this reality, but the reversion to lower growth trends following the booms starkly frames this challenge. Looking more closely, while there has been great progress in macroeconomic management, there are a number of structural challenges in the region that appear to be weighing on growth. For example, many countries in the region have dramatically opened themselves to the global economy, including through significant tariff reductions. Yet, international trade relative to GDP remains relatively low. Moreover, raw materials with limited value added continue to account for a large share of the region's exports. Intra-regional trade dramatically lags other parts of the world, despite the spread of regional FTAs, customs unions, and common markets. Countries also have relaxed restrictions on foreign investment. By 2014, the stock of FDI in the region was equal to roughly a third of regional GDP. This share is almost 4 times larger than in 1990 and exceeds the current share in developing and newly industrialized Asia. This FDI, however, is disproportionately in the commodities sector, and much of the region remains relatively disconnected from the high value-added supply chains that have propelled growth in Asia. As a related issue, the region also suffers from a low level of domestic savings, with a correspondingly inadequate level of overall investment at around 20% of GDP. One feature over time has been the development of a sizable infrastructure deficit. Investment in innovation also lags, with spending on research and development less than half that recorded in developing East Asia or the advanced economies. An important implication of these structural features of Latin American economies is that productivity growth has been persistently low, again lagging the experience of developing Asia. Addressing such obstacles to growth remains an urgent need, and it will require concerted efforts on the part of policymakers. In an environment in which global growth is falling short of expectations and the growth of global trade by even more, countries will not be able to rely on external demand as the solution. The remarkable progress and notable challenges that I've described can be seen in richer detail in economies throughout the region, though each has its own unique story. Of course, I will begin with our immediate neighbor. Prosperity in Mexico is strongly in the U.S. interests for our economy and our national security. We are very supportive of the historic reforms that have been put in place by President Peña Nieto and Secretary Videgaray to increase productivity, improve fiscal sustainability, and attract foreign investment. Mexico and the United States are working together to deepen the connectivity of our two economies, for example, by facilitating both commercial and financial flows. Through these efforts, we are creating opportunities for dynamic firms and workers in both of our countries to develop globally competitive supply chains. I was recently in Mexico City, where I met a Mexican entrepreneur who is deploying latest generation technology in small-scale oil fields in Texas. Mexico's sustained reforms and its continued solid economic management are positioning the economy to contribute to and benefit from stronger U.S. growth. Still, as the cover of The Economist this week reminds us, Mexico continues to face the challenges of integrating more of its population into the modern formal economy while moving forcefully to tackle crime and security issues and to improve governance at all levels. Now, turning to Brazil, Finance Minister Levy and the economic team are undertaking a tremendously difficult adjustment. Brazil faces fundamental questions about the role of the state and the affordability of entitlements. Our message to Brazil is not to lose resolve and to remain focused on laying the groundwork for the Brazilian middle class to realize its aspirations. Ongoing investigations of economic crime in Brazil have revealed corruption that is a tax on all Brazilians. The silver lining is that Brazil's institutions are proving to be sound. In the medium term, Brazil should emerge a stronger and a more dynamic economy. Also notable has been the development of the Pacific Alliance, as Mexico, Colombia, Chile, and Peru have created a brand of deeper economic integration, strong institutions, and openness to pan-Pacific trade and investment. We are open to broadening discussions with these countries on issues such as infrastructure financing and financial intelligence. In Central America, migration has been driven by a complex set of factors, including lack of economic opportunity and security concerns. Addressing these issues will require sustained and focused effort. There need to be jobs for new workers, and people must feel safe on the way to work or school. Pursuing economic integration with more vigor would allow these countries to take better advantage of economies of scale and proximity to North American value chains. Let me also recognize the work of the president of the Inter-American Development Bank, Luis Alberto Moreno, whose leadership in the Northern Triangle has been and will continue to be a critical part of a successful strategy. Through his personal association with Plan Colombia, he understands deeply that while foreign assistance is necessary, countries need to own strong policies to improve governance, security, and economic opportunity. Venezuela has the largest proven oil reserves in the world, yet its economy was in sharp decline well before the fall in oil prices last year. It's clear that policy, not lack of resources, is the problem. A good place to start would be for Venezuela to honor its obligation to the IMF to permit surveillance through Article 4 missions, which Venezuela has not done since 2004. Finally, the historic visit of Pope Francis this week highlights that the United States has a new platform for diplomatic engagement to advance our long-held objective for political and economic reform in Cuba. We encourage the Cuban government to move forward with reforms, to increase economic opportunity for its people, and to provide the conditions to build democratic, prosperous, and a stable Cuba. It's also worth mentioning that Jamaica has performed exceptionally well under its IMF program and very much deserves the support of the international community. All of this brings us to a very important question. What are we, the United States and the economies in Latin America, doing together? One area that needs to be part of Latin America's growth agenda is an increased focus on investment in both physical and human capital. Reducing the region's infrastructure deficit should be one key part of this effort. Several countries are prioritizing plans to promote national and regional connectivity, including major efforts to mobilize private capital. Treasury staff have informally canvassed some U.S. firms on what would be necessary to increase U.S. private sector investment in infrastructure in Latin America and the Caribbean. As you might expect, there's not one single answer. In some cases, our firms may not have the local knowledge to compete, or they may simply seek a less risky financial return in US dollars. But a common theme has been the need for open lines of communications between governments in the region and foreign investors. Another impediment cited by our firms was a lack of transparency, given their need to comply with the Foreign Corrupt Practices Act. While such concerns are in no way unique to Latin America, a number of countries in the region must tackle corrupt practices and ensure a level playing field for all potential investors, including dynamic domestic entrepreneurs. When it comes to investing in people, it remains the case that the region's human resources are underutilized. It clearly is not for lack of talent. For example, I recently gave a talk to economics undergraduates in Bogota, and I was highly impressed with the sophistication of the students' questions. Fortunately for me, delivered in excellent English. While many countries have improved access to education, much work still needs to be done on raising standards. Finally, a 21st century trade agenda remains essential to our joint efforts to promote prosperity. We are working to secure a final Trans-Pacific Partnership Agreement, or TPP, that fosters stronger economic growth in the United States and in our partner countries. And we are pleased to have 3 countries from Latin America who are participating. This agreement aims to establish an open architecture that welcomes potential entrants from the region in the future if they are willing to meet the high standards of the agreement. The list above is not intended to be exhaustive, but there is a clear set of challenges facing the region, and standing still is not an option. Treasury looks forward to collaborating with policymakers in the region to secure important advances in reducing poverty and inequality, and in building the strong middle-class societies that are essential for prosperity at home and abroad. Thank you. I look forward to your questions.
Well, thank you, Mr. Secretary, for those comments.
Thank you.
You hit all of the right notes and did so, I think, effectively. So thank you and congratulations for that. You mentioned at the beginning of your talk the Lima meetings. Obviously, these aren't just Latin America meetings. These are the broader global meetings. And before we get into the Latin America agenda specifically, which you spoke on, of course, there's a question out there in terms of quotas and IMF reform and some of those questions. Maybe you have a thought on that you'd like to give to us, because that's on the minds of a lot of people.
I do indeed have some thoughts on that question, and very much appreciate you articulating that. It is clear that the 2010 quota reforms are very much in the interests of the United States, interests of the IMF, and interests in the interests of an effective, well-functioning global economy. When I think about the IMF brings a lot to the table. Certainly, it has the capacity to provide financing to help during periods of macroeconomic adjustment. But I think what I'm finding as I work closely with the fund in my current role is that the expertise and the human capital that the fund brings to the table and its capacity to provide technical assistance to countries is equally crucial. And we've seen the fund's effectiveness in a number of countries in the region. Another place where we've worked very closely with the fund has been in Ukraine, in helping that country implement reforms. And it's just simply imperative that the United States continue to play the leadership role in the fund that the world expects us to play. If we walk away from that leadership role, it's very much to our peril. It's also worth emphasizing that these reforms preserve the US veto, expand the financing base and capacity of the fund, and also modernize the fund, and that they recognize the increased role of emerging markets like Brazil and Mexico in the global economy and give them a greater say in the voting structure. So the quota issue is one of great importance, and we very much call on the Congress to pass those reforms as expeditiously as possible.
Thank you very much. Well, let's bring the lens back to the Latin America agenda. You talked very effectively about some of the reforms that Latin America, broadly speaking, has taken, some of the positive impact, and yet the region continues to lag behind some of its peers in other emerging markets. One of the success stories that we and many others have pointed to has been the rise of the middle class in the Western Hemisphere, moving millions of people out of poverty, a tremendous historic success. At the same time now, with commodities markets going another direction, and some economic challenges, as you pointed to, there may be a risk of some of the middle class, in fact, reverting back into poverty. Are you concerned about that? Are there things that governments in the region should be doing to mitigate that potential, at the same time trying to address some of the financial and economic challenges that they face?
These issues are of great importance. As you indicate, the success over the last decade of building a vibrant middle class in Latin America is unparalleled. I mean, that the objective of all of our economic policies and economic initiatives should be to raise standards of living for as many people as possible. Now, I think that in some deep way, what we are seeing in Latin America is the ongoing development of a domestic demand-driven model of development and growth. And I think that it's one that is, if not unique to the region, because maybe there are some other parts of the world where we've seen this as well, but it's certainly one that characterizes the region. So I think that is constructive and helpful in a world which is often deficient in terms of domestic demand. And what are the next steps? I think the next steps are very much along the kinds of things that I articulated in the speech. The more structural kinds of policies, the macroeconomic policies are much stronger than they were a generation ago. But now it's moving into infrastructure and reducing bottlenecks. I was recently in Brazil, in a region where they had just developed a new port that was absolutely state-of-the-art, but all the roads to the port were not in place. So it wasn't functioning in bringing the efficiency that it could. Another framing of this, of the bottleneck point, is in many Latin American factories, inside the factory gate is absolutely world-class. But outside the factory gate, the roads and the infrastructure that are necessary to make that factory fully competitive are not yet in place. And I think those are the kinds of the deep structural challenges of investing in people, of creating a climate that facilitates investment and getting the infrastructure in place is the challenge for the next generation of policies and reforms in Latin America.
Mm-hmm. Latin America historically has been defined in some ways by the boom and bust cycle. And as you've appropriately indicated, the so-called bust at this point is not nearly as bad as it's been in the past, and I don't think it will be. But at the same time, other parts of the world, other regions have found ways to even out those cycles in some way. And I guess as we look forward into 2016, you indicated growth maybe at 1% across the region and recession this year. What lessons can we learn from where we've been and where we're going to position Latin America, broadly speaking? And again, you indicated differences in the region with country to country, absolutely. Yeah. But broadly speaking, are there some lessons? Are there some trends? Are there some ideas that all of us together should be promoting to try to keep a positive growth path for the region?
So the volatility in the business cycle that you mentioned, I think, is largely a reflection of the region's dependence on commodities. And commodity cycles tend to be quite pronounced. So along with this focus on investment, I think there's also a corollary of a rebalancing in the economy, a continued effort to diversify away from the commodity sector. I think that there will be, with over 1 billion Chinese and over 1 billion Indians looking for Western kinds of lifestyles, I think over the medium to long run there will be ample demand for commodities, but a more diversified sectoral mix I think will be very constructive and helpful in smoothing through those cycles. The other point I would make that I think is important is the central banks in the region, I think, have gone a goodly way toward establishing credibility. And I think that this will be a tool that over time will also help to contribute to a less volatile business cycle. In response to the meaningful declines in exchange rates in the region, in previous generations, central banks would have had to hike rates furiously. And it's really quite striking that for Mexico, Colombia, Peru, and Chile, in all of those economies, they've seen meaningful exchange rate depreciations, but the policy rate is in the 3 to 4.5% range. So that central banks have been able to maintain a fairly stimulative stance of policy and support the economy through the business cycle in the face of the depreciation without there being a significant inflationary breakthrough. So exchange rate pass-through is lower, which gives them more scope. And again, I think that reflects the credibility of these institutions.
And if I'm not mistaken, I wrote the countries down. You just referred to the 4 countries of the Pacific Alliance, which and
that's
you spoke
absolutely
about
right.
in your remarks, and we're big supporters of the effort as well. So the Undersecretary's time is limited this morning. There is a huge amount going on, but he has agreed to take a couple questions from the floor. So to the extent that there may be questions, we would ask you to identify yourself by name, organization that you're representing, and now the opportunity is yours. We do have a circulating microphone. Please, right here. Let's bring the microphone up so that those tuning in via the webcast will also be able to hear it. Thank you.
Thank you so much. Good morning, and thank you for the excellent presentation. My name is Susana Carrillo, and I work for the World Bank. And you mentioned the importance of the IMF in terms of technical assistance to the LAC region. And I would like to know if you have any thoughts about the voice and reform agenda that is being pushed by some of the Latin American countries. And that's my first question. And my second, if I may, it's if you have any thoughts about the role of Chinese investments in infrastructure that is growing in the region. Thank you.
Please.
In response to your first question, my sense is that for the IFIs to be as credible as they need to be, it is imperative that their governance structure reflect the realities of the global economy today. And one of those realities is that emerging markets have a greater share. The weight of the emerging markets has grown dramatically over the last decades. And the governance of the IFIs and the capacity for countries to articulate their views and to have voice should broadly reflect that reality. Your question regarding China's role in the region is a very important one. One obvious linkage between China and the region is that much of the region's commodity output has been consumed by the Chinese. With the Chinese economy now in a moderating trajectory, the growth of that commodity demand has slowed significantly. I think that's a significant channel. My expectation is that Chinese growth over the medium to long run will gradually slow, that we'll see growth this year and next in the 7-ish range, but gradually move toward that of other emerging market economies. But it will not, China won't face a crisis, there won't be a severe slowing of growth, which I think is a good story for commodity producing countries. China is also an important source of investment, particularly in infrastructure. And I think that this can be helpful and provide constructive financing and support for the region. Would very much welcome co-financing with the MDBs. And in any event, our sense is that it's very important that Chinese investment and Chinese projects be implemented in a way that are consistent with international standards, international safeguards, and international best practice for issues like debt sustainability of the recipient country and environmental and social impacts.
Another question. There's one in the back.
Ian Talley, Wall Street Journal. Always a pleasure. I always feel like I learned something thinking about hearing how you see the view of the world. I wonder about your optimism, however, with Brazil in terms of implementing the structural reforms that you're saying that are so necessary. I think since government's been in power, there have been a lot of promises, as elsewhere in the world, and actually retreat from implementing or rolling out those structural reforms. And it would seem to me that a much deeper recession and the political crisis that they're facing would make those reforms all the more harder. Why do you have optimism there and elsewhere?
Good question. Thank you. Certainly, Brazil is in a place now where it faces some challenges and some difficulties, and its economy is contracting. There are challenges for macroeconomic management, including fiscal policy. There's structural and competitiveness challenges, and in addition, political uncertainties associated with the Petrobras situation. So this is a challenging time for Brazilian policymakers. But there are also a number of important positive factors when I look at Brazil. The country has a flexible exchange rate regime, has absorbed a significant depreciation, which I think over time will help support growth. That has occurred without any kind of financial stability, disruptions having been seen. I think it underscores the fact that the banking system there is in much better shape. They have a substantial stock of reserves, which is another important buffer. And my sense is that Minister Levy and Governor Tombini and the economic team are very much committed to sound economic policies. Now, I think, though, that this question, maybe this broader discussion that we're having about Latin America, also underscores the importance of the work that we're doing in the G20. It's imperative that countries throughout the world, and that means the United States and in Europe and in Asia, and in Latin America to the extent possible, take steps to support demand and implement policies that will help support the sustained and strong and balanced growth that we're looking for. That will be a key, both for those individual economies performing as well as they possibly can in developing high levels of consumption and welfare for their people, but also for providing global support to regions of the world that are facing business cycle softness and business cycle downturns.
Thank you. I think we have time for one final question, to the extent that there may be one. Absolutely. Mm-hmm.
Thank you very much.
We've got the mic coming. Yep.
Oh, sorry.
Yep. We know who you are, but many others don't.
Thank you very much, Bob Kaplan from the Inter-American Foundation, and thank you very much for your presentation. And you've pointed to a lot of really important changes in the region and advances. And it's clear as one travels around the region that you can actually see the impacts of that. One thing that really troubles me, and has troubled me for some time, is that despite advances in poverty reduction, it really hasn't kept pace with population growth. So there are 31 million more poor people in Latin America today than there were in 1980. Those are from UN Economic Commission for Latin America figures. 31 million more poor people today than there were in 1980. So I'm wondering if what you would say about all of the advances that are necessary, and clearly productivity improvements and infrastructure, but are there other things that need to be done in order to really focus the attention on inclusion of people who are really left behind and who have been left behind and are continuing to be left behind even during periods of strong growth?
Thank you for that question. I think that the points you raise are ones that are certainly relevant to Latin America and the Caribbean, but very much relevant to the rest of the world. How do we achieve inclusive, fair, equitable growth? And my sense is that there are a lot of elements to an answer, but not one single silver bullet as a solution. Certainly strong educational systems are crucial, continuing to invest in human capital. One area where the Treasury has been vitally engaged is promoting financial sector reforms that reach out to people at all income levels to provide support, to facilitate entrepreneurial kinds of enterprises and activities that I think development of the financial system is crucial. And then I think it's beyond that. I think it's the kinds of meat and potatoes kinds of issues and policies that I've described, delivering on the one hand the stable macro environment. I think that low and stable inflation is in the interests of all people throughout society. Coupled with strong structural policies that as we promote investment, I deeply believe that investment and employment are complements. And as we're promoting investment, we're also promoting employment. And this set of issues that you raise, I think, is at the forefront of the agenda for the policymaking community for the Treasury, but I also think for the academic community. And hopefully, in 5 years, we'll have better answers.
Well, this has been a tour de force. Clearly, the interest is there in terms of what you're doing, what your department is doing, the important work that you're doing. Perhaps after Lima, we can get you or other Treasury representatives to come back.
Happy to.
We think the world of the connectivity agenda that you all are promoting. We want to be partners in that, so we thank you for those comments. And I've been with the Council of the Americas now 12 years. I think this is the first time in that entire time I've conducted a conversation where both Paraguay and Jamaica have been brought into the conversation. And so I would congratulate you for that. That is fabulous. Ladies and gentlemen, would you please join me in thanking Undersecretary of the Treasury, Dr. Sheets, for his terrific comments this morning.